happy Wednesday, October 14th. Welcome back to another exciting edition of Rate Desk. I'm your host, Michael Thomas, here to talk about multifamily interest rates and other news. First, going to the markets today, all three major indices are down and in the red. Not significantly down, but they are down a little bit, mainly as a result of some mixed economic news about bank performance. Both Bank of America and Wells Fargo had profit declines. Also some of the vaccine news, where a few of them appear to be stalled out right now. And then, of course, the general choppiness around the election. Fundamentals remain strong, but we are seeing all three of them closing down in the session today. Going over the U.S. 10-year Treasury yield, we are seeing that narrow up a bit from where we were last week. Today, it's trading at 72. That is 0.72 today on the 10-year U.S. Treasury yield. You know, one analyst said that it could be 1% by the end of the year. I mean, who knows? I mean, is it right that our U.S. 10-year Treasury yield is trading so low? I mean, do we have things in the market that are continuing to necessitate that type of very, very low yield on the 10-year? I think that's a great question going forward. And of course, mortgage rates are sensitive to changes in the U.S. 10-year Treasury yield, so we'll keep a close watch on that here. Of course, jumping over to the multifamily interest rates, FHA rates are down a little bit from where they were last week. We saw them tighten back up after the increase in the U.S. Treasuries pushed our rates up a little bit. They've settled back down a little bit lower, about 6 basis points lower. So the 223F 35-year fix today is quoting at 223. That is 2.23. And the 221D4, that is the 40-year fixed rate construction, that is quoting at 2.83. So again, phenomenally low interest rates, but also nice to see them tighten a little bit from where they were last week. Going over to the agency desk, we're seeing the Fannie Mae somewhat to be in the range-bound arena still. That's quoting at about 2.84 today. That's on the low end of their spectrum range there. And Freddie Mac on their 10-year money, probably the low end range is about 3.05. Now, I was checking with my agency desk contact there, and the affordable, what they define as affordable, which has to do with the income range of the tenant base that's served by that property, could get into the 295, maybe even slightly lower. So they will get more aggressive on those mission-rich type of assets. And it just made me think of, in this market and this economy, what kind of a lender are you working with? What kind of a lender are you seeking? And I'm not sure that that borrowers are always making these distinctions. You know, when you need money to do something, you tend to just go look for money. You're not really starting to think too much beyond that. But when you think about a lender such as myself at HUD and other agency folks, we're mission oriented. So our part of the mission of the money that we shepherd in these loan products is really designed to provide access to capital for a mission. The mission might be affordability along the agency line. HUD has multiple missions as well that deal with affordability. Also, from the HUD perspective, we are very open in terms of geography, so we can serve those smaller rural markets. We're not sort of held back by investors dictating that we are only lending in certain major markets that have a certain population demographic, et cetera. So that's also true about USDA. And in fact, USDA, they do target even the smallest of the small communities, where HUD doesn't really count the number, but they do just lend anywhere, essentially. USDA will target their funds towards the smaller communities. So I just bring that up. I think it's important to kind of know what you're looking for, what kind of money, where you're at, and that can guide you towards, should I go conventional or should I go more towards a mission rich type of a lender, like either that GSE or a HUD FHA. So that's just food for thought, came up today. Another thing I wanted to speak with you about was the technology changes, which are a positive, that are occurring at HUD. One just came out, very excited to report on, is a new electronic submission portal for HUD that we can submit all of these FHA applications now online electronically. We were, believe it or not, printing them out and submitting them with paper documents, and they are long, folks. I'm talking like 1,000 pages long, and of course, you're not just doing one copy, you're doing multiple. So what a great, lean exercise to go electronic. So certainly a silver lining there. Nice to see HUD stepping up and really leveraging the cloud and some of the other technologies that are out there now to make the application process way more efficient and just save resources that way. So kudos to HUD on that. And I want to also mention one other thing about the green HUD energy efficiency mortgage insurance premium. A lot of borrowers want to go for this MIP because it is 35 basis points lower than your other option, which is the market rate MIP. So it's 25 basis points versus 60 basis points. I'm talking on a refinance here. So at any rate, and not affordable. Affordable has its own MIP, but to get that 25 MIP, there is a path forward now, which is still kind of the path of least resistance in some ways, where you can qualify under the Energy Star portfolio rating. This was the first and foremost way properties qualified for green. There are new standards that HUD is leaning towards, but currently you're still able to qualify with the Energy Star. But here's how you do it in a new construction project, which I just found out about. In a new construction project, you're not going to have 12 months of utility usage data. That's a problem because you can't benchmark to an Energy Star score unless you have that usage data. So what do? Well, you hire a consultant that will do a statement of energy design intent. It's also called a SEDI for short. This SEDI will look at the architectural plans, look at all of the building features, the components that have to do with energy and efficiency, and they will model out based on that. Model out a score and say basically, based on all of this information and these numbers we've crunched, this is what the energy efficiency rating would be for this property. Now you have to confirm that 12 months post-closing. Now, after you submit the loan to HUD, 12 months later, you have to do a statement of energy performance. That's called an SEP. That will tell you, did you do what you said you were going to do in the SEDI? Did you hit that goal? Then you certify to that green standard. It's another step in the process, but it's important, and it's the official step that gives you the stamp that says you are now certified green. And after that point forward in time, all you're doing is certifying data annually. You're not redoing the entire score, you're pumping out the data. So you do need to have a data management plan. That can cost anywhere from $500 to $1,000 a year, not an astronomical cost. On larger loans, when you're getting this gigantic reduction in the MIP, by the way, your MIP at initial deposit, if you are green, goes to 25 basis points from 1 percentage point. So you're saving 75 basis points at loan closing. So just imagine the dollars, the millions of dollars really you're saving on these larger loans. So certainly it's worth doing the extra work, the extra effort to get some of these reports going, to see where the score is at and pursue this process. I thought that was a good news without having to use some of these much heavier certification programs, which involve you going back into the property. And if it's new, who wants to do that? And essentially rebuilding components to become more efficient. Again, doesn't make a lot of sense, but the Energy Star portfolio with the SEDI and the SIP still makes great sense. So that's great news. Talk to your lenders about that. If you've got a new property and you want to qualify for green MIP with HUD, there is a path forward on that. And on that note, I'm going to give you that as my tip of the week. Thank you all for tuning in to another exciting edition of Rate Desk. Hey, be sure to check out Money Talks with Evelyn Lim. She's the Region 8 admin. I had a great interview with her. That episode's coming out soon. And come right back here for the latest news in multifamily interest rates. I'm your host, Michael Thomas, signing off.